Let me just talk about putting money in the bank here. So compounding. If you have annual compounding, what that means is that, and you have an interest rate of R, and you put your money in the bank with annual compounding, and the interest rate is R, that means you don't earn interest on interest until after a year. You put your money in today. Half a year later, if you put in $1 today, half a year later, you'll have 1 plus R over $2, right, with an interest rate R. 3/4 of a year later, you'll have 1 plus 3/4 R dollars. And then a full year later, you'll have 1 plus R. But now, after 1 year, you start earning interest on the 1 plus R. So a half year after that, you would have 1 plus R times 1 plus R over 2. Okay? And then 2 years later, you'd have 1 plus R squared, and so on. That's annual compounding. But the bank could offer you a different formula. They could offer you every 6-month compounding, twice a year compounding. Then here's the difference. After half a year, you'd have 1 plus R over 2, as before. But now, after 3/4 of a year, you would have instead 1 plus R over 2 times 1 plus R over 4, and so on, okay? Now, what Fabozzi likes to do is compounding every 6 months. This is what might make the textbook a little confusing, because we naturally think of annual compounding, because a year seems like a natural interval. But in finance, 6 months is more natural, because by convention, a lot of bonds pay coupons every 6 months. So Fabozzi uses the letter Z to mean R over 2. And his time intervals are 6 months long. Okay? So that means that the formula that Fabozzi gives for a discount bond, since it assumes a different compounding interval, the Fabozzi assumption, he writes P equals 100 all over 1 plus Z to the lowercase 2t, where lowercase t is 2t. And so that's the Fabozzi formula for the price of a discount bond. And of course, it only applies at every 6 months interval. He's not showing what it is at 6.5 months or something like that. So that's, okay, is that clear about compounding and about discount bonds? Okay. Now, a fundamental concept in finance is present discounted value. If you have a payment coming in the future, so I have a payment in T years, or 2T 6 months, we could say semesters, then the present value, depending on how I compound, the present value, well, let's talk about annual compounding. The present discounted value of a payment in T years is just the amount, which is X dollars divided by 1 plus R to the T. Or if you're compounding every 6 months, it would be X all over 1 plus Z to the little lowercase t. All right, lowercase t equals 2t. So whenever we ask a question about present values, we'll have to make clear what the compounding interval we're talking about. By the way, there's also, I shouldn't say by the way, it's fundamental. There's also continuous compounding. I talked about compounding annually or twice a year. I can do it 4 times a year. If I do it 4 times a year, that means I pay 1/4 of the interest after 3 months, and then I start earning interest on interest after 3 months, and so on. What if you compound really often? Not every. You could do daily compounding, or that would mean you would pay. You would start earning interest on interest 365 times a year. The limit is continuous compounding. Okay. And the formula for continuous compounding is e to the RT, where e is the natural number 2.718. R is the continuously compounded interest rate. So your balance equals the initial amount, what did I say, $1 times e to the RT. That's continuous compounding. Okay. Now if you have a number of, so the unfortunate thing is that present values allow us to compute present values in different ways depending on what kind of compounding I'm assuming. If I have a sequence of payments coming in, the present discounted value of the sequence, and suppose they come in once a year, then it would be natural to use annual compounding, and then the present discounted value, PDV, is the summation of the payments. And what am I calling them here? X sub I all over 1 plus R. No, I say X sub T all over 1 plus R to the T, from T equals 1 to infinity. And that's the present discounted value for annual compounding of annual payments. And if, suppose the payments are coming in every 6 months, as they do with corporate bonds, then it might be natural to do compounding every 6 months. So then we do PDV is equal to the summation T equals 1 to infinity X sub T all over 1 plus R over 2 to the T. And limiting, if I want to do continuous compounding, suppose I have payments that are coming in continually, then the present discounted value would be the integral from 0 to infinity of x sub t e to the minus rt dt. And that would be a continuously compounded present value for a continuous stream of payments. So if someone is offering me payments over time, then the payments then have to be summed somehow into a present value. And this is, in finance, it often happens that people are promising to pay you something at various future intervals over time. And you have to recognize that payments in the future are worth less than payments today. Just as a discount bond, it's worth $100 in 5 years, but it's not worth $100 today. It's worth 100 all over 1 plus r to the t, appropriately compounded. So the interest rate, and that's true generally, anything in the future is worth less. So present discounted value is one of the most fundamental concepts in finance, that whenever someone is offering me a payment stream in the future, you discount it to the present using these formulas. There's a few present value formulas that are essential, and I'm going to just briefly mention them. The present value of a console or perpetuity. A perpetuity or a console, is an instrument that pays the same payment every period forever. Okay? It's named after the British consols that were issued in the 18th century. They were British government debt that had no expiration date, and the British government promised to pay you forever an amount. Okay, what is the present value? Now we'll call the amount that the console pays its coupon. Okay, and let's say the coupon were £1 per year. If it was paying £1 per year and we're using annual coupons, annual compounding, then the present discounted value is equal to £1, okay, over the interest rate. It's a console for a while and then it stops. An annuity pays a fixed payment each period until the expiration of the maturity of the. So the formula for so it pays, let's say X pounds, let's not say £1. If it pays X pounds every year, then the present discounted value, and it pays X pounds from t equals 1 to capital T, and then it stops. Capital T is the last payment. Then the formula is x over r times 1 minus 1 all over 1 plus r to the tth power. So that's the annuity formula. And that's very important because a lot of financial instruments are annuities. The most important example being a home mortgage, a traditional home mortgage. You might take out a 30-year mortgage when you buy a house. And the mortgage will generally say, in the United States, it's not so common in other countries, but in the United States, it will say, you pay a fixed amount. Well, usually it's monthly, but let's say annually for now, okay? A fixed amount every year as your mortgage payment. And then you pay that continually until 30 years has elapsed, and then you're done. No more payments, okay? The final thing I want to talk about is a corporate bond, or a conventional bond, which is a combination of an annuity and a discount bond. And so a conventional corporate bond or government bond pays a coupon every 6 months. So a conventional bond pays coupon C, an amount C in dollars, pounds, or whatever currency, every 6 months. And principal plus C at the end. So that means that you, it's really an annuity and a discount bond together, right? And so the present discounted value for the conventional bond would be the sum of the present discounted value for using the annuity formula for x equals C plus the present discounted value of the principal, which is given by the, well, it would be this one where we have r over 2 because it's every 6 months. I want to talk about forward rates and the term structure of interest rates. Now, at every point in time, there are interest rates of various maturities quoted. And we want to define the forward rates implicit in those maturity formulas. And this is covered carefully in your textbook for Bosey. I'm just going to do a very simple exposition of it. So the forward rates are the concept of a forward rate, forward interest rate, is due to Sir John Hicks in his 1939 book, Value and Capital. Value and Capital. About 20 years ago, I was writing a chapter for the Handbook of Monetary Economics about interest rates. And I was trying to confirm who invented the concept of forward interest rates. So I'll build a little story around this. But I thought it was Sir John Hicks reading his 1939 book, and I couldn't find any earlier reference. So I asked my research assistant, can you confirm for me that the concept of a forward interest rate is due to Hicks? And my graduate student looked around and tried to find earlier references to it, and he could not. And then one day the graduate student came to me and said, this is like 20 years ago, the graduate student said, why don't you ask Hicks? I said, wait a minute, this book was written in 1939. Is that man still alive? And he said, I think he is. So I wrote to the United Kingdom. I found his address, I forget, Cambridge or Oxford, I forget. And I said, did you invent the concept of forward interest rates? And then 6 months went by and I got no answer. Then I got a paper letter. They didn't have email in those days, from Sir John Hicks. And it was written with trembling handwriting. And he said, my apologies for taking so long to answer. My health isn't good. But he said, to answer your question, he said, maybe I did invent the concept of forward interest rate. But he said, well, maybe it wasn't. Maybe it was from coffee hour at the London School of Economics, where he was visiting in the 1920s. Okay, so here we go. Sir John Hicks is reminiscing to me about what happened in coffee time in the 1920s. He said, we were thinking about, so I'm just trying to convey what he told me they were thinking. At any point of time, you open the newspaper and you see interest rates quoted for various maturities. That's called the term structure of interest rates. And the term structure of interest rates, for example, you'll find Treasury, well, you'll find 1-year rates. Quote, there'll be a yield on 1-year bonds. There'll be a yield on 2 years. There'll be a yield quoted on 3-year bonds, right? Let me tell you right now, for most of the world today, if you want to borrow money for 1 year, it's really cheap. In Europe or UK, US, over much of the world, it's like 1%. US, it's less than 1%. I mean, the depends on who you are, what your borrowing rate will be, depending on your credit history. But if you have excellent credit, 1-year interest rates are really low. But if you want to borrow for 10 years, it's more like 3.5%. It's higher, right? So, and if you want to borrow for 30 years, they might charge you 4 or 5%. Okay? This is the term structure of interest rates, and it's quoted every day in the newspaper. Well, I should say, I'm thinking 1925. In 1925, you'd go to the newspaper to see it. Now you go to the internet to see it. So newspapers don't carry this anymore. But I'm still in the mode of thinking of Sir John Hicks. So we're in 1925. So you open up the newspaper in 1925, and you get the yield to maturity, or the interest rate on various maturities. All for today. Everything that's quoted in today's paper is an interest rate between now, today, and so many years in the future. The 1-year interest rate quoted is the rate between now and 1 year from now, right? And the 2-year interest rate quoted is the rate from now to 2 years from now, and so on. So Hicks and his coffee hour, people were saying, well, it seems kind of one-dimensional because all the rates that are quoted are rates between now and some future date. But what about between 2 future dates? And then they thought about this at coffee hour, and someone said, well, it's kind of unnecessary to quote them because they're all implicit in the term structure today. And this is where the concept of forward interest rate comes. And it's explained in Fabozzi, but I thought I'm going to just try to explain it in the simplest term. Once you get the concept, it's easy. And I'm going to assume annual compounding to simplify things. But in Fabozzi, he, being a good financier, does it in 6-month compounding. So now we're in the year is 1925, okay, and we're in coffee hour, and we're talking about, suppose I expect to have, I'm just trying to get my 100 pounds to invest in 26. Okay, it's 25 now. This is a whole year from the 1926, okay? And I want to lock in the interest rate now, okay? Is there any way to do that? I mean, I could try to go to some banker and say, can you promise me that you'll give me an interest rate in 1926 for 1 year? The banker might do it, but I don't need to go to a banker to do that. I can, once I have all of these bonds available, and if I can both go long and short them, then I can lock it in. So here's what I want to do. This is what they were discussing at coffee hour. Buy in 1925 2-year bonds in an amount. You've got to buy the amount right. You've got to buy 1 plus R sub 2, which is the 2-year yield, squared all over 1 plus R1 bonds, discount bonds. They'll mature in 2 years, okay? And then I have to short in 1925 one period bond. Okay, suppose I do that, worth 100, that matures at 100 pounds, okay? So suppose I do that. What happens after 1 period? Well, after 1 period, I owe 100 pounds, right? Because I just shorted a 1 period bond. And so I pay 100 pounds. That's like investing 100 pounds. At the end, I get this amount. I get this amount times 100 pounds, right? Because this is the number of bonds that I bought. So what is the return that I get? The return that I get is the ratio. It gives me the, we'll call that the forward rate between 26 and 27 as quoted in 1925. And so that forward rate, we'll say 1 plus the forward rate, F, is equal to 1 plus R2 squared all over 1 plus R1. It's just the amount that I get. Because this is what I'll get if I bought this number of bonds. I get 100 pounds times this number in 2 periods in 1927. But I put out 100 pounds in 1926. So the ratio of the amount that I got at the end to the amount that in 27 that I put in 26 is given by this. So that's 1 plus the interest rate I got on the bond. The expectations theory of the term structure is a theory that, I'll write it down, expectations theory says that the forward rate equals the expected spot rate. So you see what I'm saying? Here in 1925, I opened the London Times, and right there I have printed the whole term structure today, and I can then compute using forward rate formulas the implied interest rates for every year in the future, even out to 2010. They could have computed, if they had bonds that were that long, and I think they had a few. See, 1925, some bonds go out 100 years. If you wanted to do the 1-year rate in 1925 for the year 2011, you'd have to find a pair of bonds, one of them maturing in 2011 and another one maturing in 2012. And if you did that, you could get an interest rate for this year. So that was kind of the realization that Hicks got, that the whole future is laid out here in this morning's paper. All the interest rates for, maybe not out to 2011, but out to a long time in the future. And so what determines those interest rates? So Hicks in his book wrote, the simplest theory is the theory that these forward rates are just predictions of interest rates on those future dates. So we could go back and see what were they predicting for. They weren't thinking so clearly, definitively about 2011, but they must have been because they were trading these bonds. And so you could test whether the expectations theory is whether people are forming rational expectations by looking at those forecasts and seeing were they right. What I've laid out here is a theory of interest rates, and I've done some interest rate calculations, and I've pointed out the remarkable institutions we have that have interest rates for all intervals out maybe 100 years. And so it's all kind of like the whole future is planned in these markets. It seems impressive, doesn't it? But the question is everything really... And when I told you the Robinson Crusoe story, didn't that sound good? Like when the two Robinson Crusoes discover each other, aren't they obviously doing the right thing to make a loan from one to the other? I like that. I think basically everything I've said here is basically right. But I wanted to say that one of the themes of this course is about human behavior and behavioral economics. And I wanted to talk a little bit about borrowing and lending and how it actually plays out in the real world and how our attitudes are changing, our regulatory attitudes are changing. So let me just step back and, I think this literature that Irving Fisher and Boone Bavruk and many others who've contributed to the understanding of interest rates is very powerful and important. And it supersedes anything that had been written in the last thousands of years. They had interest rates for thousands of years. But that simple diagram, that Fisher diagram, came just a short time ago. It's hardly long ago at all. But I wanted to step back and think about what people said about interest rates going way back in time. And so I was going to quote the Bible. Okay, there's a Latin word. Do you know this word? Do you know what that means in Latin? Well, actually, our English word use comes from it. So I don't know how to pronounce it. Usura in Latin means use, and it means also interest. because what is interest? You're giving someone the use of the money. You're not giving them the money, they're getting the use of the money. And they had other words for interest, but this ancient word had a negative connotation. It sounded bad. It kind of meant something immoral, okay? And so we have a word called usury. You know this word, this is English now. It's just, there's a 2,000, it goes back more than 2,000 years. So the Bible, I actually have it here in Latin. I'm just curious about these things, but I can't pronounce it right. It must have been written in Greek or Aramaic or something originally, but it uses the word usury, usura, but the quotation, it says in Exodus, "If thou lent money to any of my people that is poor by thee, thou shalt not be to him as an usurer, neither shalt thou lay upon him usury." Now what does that mean? Because usura can mean both interest and excessive interest. So it's not clear what the Bible is saying about lending. It sounds like it's telling you you can't lend, you can lend someone money, but don't take any interest. That's what it seems to be saying, but it's ambiguous. And I was going to quote the Quran. Now, I don't speak Arabic. I think there's a similar ambiguity in Arabic. And I'm quoting an English translation of the Quran. "O you who believe, be careful of Allah and give up the interest that is outstanding." Or usura. That has been interpreted by modern Islamic scholars as that charging interest is ungodly. And it was interpreted by Christian scholars. They go back and they try to figure out what was meant, and they couldn't figure it out either. And times changed over the centuries. But for thousands of years, the Catholic Church, or maybe not thousands, I don't know the whole history of this, depends on which century you're talking about, but for many centuries, the Catholic Church interpreted this, as do many Muslims today, that interest is immoral. And therefore, the only people who were allowed to loan were Jews, because they weren't subject to even though it's actually the book of Exodus, it should be, they weren't subject to the same interpretation. So it was considered immoral. And I wonder, why is that? Why is it immoral? Because we just saw the logic of it. Now, the Robinson Crusoe story, I had two different men on the other side of the island, and I had one of them wanting consumption today and one of them wanting consumption later. Your first question is, maybe they were wrong to be different. Maybe they should both be doing the same thing. Why is one of them different than the other? The guy who's going to consume a lot today, maybe I should have a word with this guy. Don't do it. You're going to be really hungry next year. Why are you doing this? So instead of forming a loan between the two, we should advise them. And maybe they don't need a loan. So this comes back to, what are we doing with our loans? And are we giving people good advice? And or do we have a tendency in the financial world to be usurious? Are we going after and victimizing people by lending them money? And I think that there is a problem, and this thousands of years of history of concern about usury has to do with real problems that develop. So just in preparing for this lecture, on an impulse, I got onto Google and I searched on vacation loans. Okay, I found 1.6 million websites that were encouraging you to take out a loan to go on a vacation. Okay, now is that socially conscious? I was wondering about that. Is it ever right to borrow money to go on a vacation? I mean, I've thought about it. And then I remembered Franco Modigliani, who is one of the authors of your textbook, and he was my teacher. I remember these moments from classroom that he was teaching us. about these subjects. And he said, he was thinking about examples of investments. And he said, you know what, one of the best investments I can think of is a honeymoon. When you get married, you go on a vacation. Now, why are you doing that? Is it for fun? Probably not. In fact, I have a suspicion that most honeymoons are not fun because I don't know. I think it's just people are too uptight and tense from what have we just done? And I bet that's right. So why do you do it? Well, you do it as an investment, right? You want this photograph album, you want the memories, you're kind of bonding. I think he's absolutely right. You should go on a honeymoon. So I did another search. I searched on honeymoon loans, okay? And I got 1.7 million hits. It beat vacation loans. So there are many lenders ready to lend, and you should do it, okay? If you're just getting married and you don't have any money, go to the usurious guy and ask for the honeymoon loan. So I'm not sure whether it's bad. This is the question. I think that there are abuses. And I wanted to just close with Elizabeth Warren, who I first met her just a few years ago. Well, actually, I remember her book. She wrote some important books about the reality. She's a Harvard law professor who wrote books. One of her books was published by Yale called The Fragile Middle Class, and it's about people who go into bankruptcy. And she points out that in the U.S., even back in the old days when the economy was good, we had 1 million personal bankruptcies a year. This is because of borrowing. You don't know how many bankruptcies there are because people are ashamed when they declare bankruptcy, and they try to cover it up from as many people as possible. There are as many personal bankruptcies in normal years as there are divorces. But you don't hear about them, right? You hear about all kinds of divorces. People are ashamed of divorces too, but they can't cover them up because everybody knows. But they can pretty well cover up a bankruptcy, and so they don't talk about it. So what Elizabeth Warren is saying, she thinks that the lending industry is victimizing people. It's advertising for vacation loans and the like, and then they don't tell people about the bad things that will come. So she wrote an article, and this is interesting. It was in Harvard Magazine, and that's a magazine that I suspect none of you read. Anyone read Harvard Magazine? Okay. It's the Harvard Alumni Magazine. It goes out to all graduates of Harvard. So you don't read it, and you probably will never read it. You will be a reader of the Yale Alumni Magazine, which will start arriving in your doorstep after you graduate. And it will also include your obituary in the next century when that comes. But the Harvard Alumni Magazine published this wonderful article by Elizabeth describing all of the abuses that happen in lending in the United States. And I think it's I don't know how I ended up reading it. I think it was just such a nicely written piece that it just became one of their success stories. Most people don't read that magazine, but I read it, and a lot of people read it. And she was so successful in convincing this is just 2008, 3 years ago. She was so successful that she got a Consumer Financial Protection Bureau inserted into the Dodd-Frank bill. We now have a new regulator that's supposed to stomp on these usurious practices. So it's kind of an inspirational story, but the downside of it is she got too carried away criticizing the lending industry in that nice article. It makes them sound worse than they really are. And so Obama could not appoint her to head the Consumer Financial Protection Bureau because it would be too politically controversial. So she is now the person trying to find someone to head her bureau. But I think that this is just another step, and it's happening in Europe and other places. The financial crisis has made us more aware of bad financial practices. And so usury is again on our mind. Usury is abusive lending that's taken without concern for the person who's borrowing. And I think that what it means to me is that we'll come back to talk about regulation in another lecture, but that the original Irving Fisher story and Bernard Boverick story about interest was right. And even vacation loans, especially honeymoon loans, are right. But we need government regulation to prevent abuses. Otherwise, and we do still have abuses in the lending process. So I'll stop with that.